Our next topic is tariffs. Definitely in the headlines every day, and I'm going to try to avoid all the political landmines around this concept and just keep it to some of the facts that I'm seeing and the impacts. And so we're going to dig into that a little bit, and then we can summarize. But let's just deal with, well, what is happening. Let's try to take Washington out of this. Let's try to take Trump out of this conversation. Let's just, at face value, let's try to unpack the tariff conversation. So I tried to pull some articles. So this was from the Wall Street Journal on July 18th, and the headline here is Corporate America Shoulders the Burden of Tariffs. One of the things that I think a lot of people were concerned with, a lot of economists and investment strategists, is that, well, this is just going to be a tax on consumers. And what we're seeing so far is really, it's like corporate America has been essentially eating some of this additional tax revenue, this additional tax cost to their business. And if you look at the right-hand side, it really shows like, okay, well, how much of these duties, tariff duties, have we collected? And you can see 2024 versus 2025. So it's been pretty substantial, about 55 billion additional. And it looks to us like it's just being borne by corporate America, which we know eventually trickles down to the end consumer. But that hasn't been the case so far. We've seen the ECB, which is the European Central Bank, they're holding rates steady because they're concerned about tariffs. So, one of the things we don't like about tariffs is that they're creating uncertainty, and uncertainty on the surface is not a terrible thing, but if you're running a country, running a business, being a consumer for you individually, uncertainty will oftentimes lead to a delay in a decision. Because if you're not certain what the future holds, you might delay a consumption decision. And that can have a trickle-down effect in the economy, because if everyone delays the decisions altogether, then that means the economy will slow because of the lack of that consumption. And so you can see here they're holding rates. They've been cutting rates. You can see the ECB is this slightly green line here. They've been cutting rates quicker than the Fed because their economies aren't doing quite as well. Now we can get into some historical data looking at tariffs. So this goes back to the 1900s. So on this chart back here, like this period of time is basically in the 30s. So you can see here we saw tariffs were pretty much a normal part of our economy, and now over the last 60 years, 70 years, it's been almost negligible. So what we're looking at here is on the far right is like, okay, well, where are we today? So when we were having some of the peak conversations around tariffs, there was this fear that it was going to be a 30% number. Now we're saying, okay, the effective rate might be closer to 15%. And, Trump has stated essentially that he wants this in the 10 to 15% range. And I don't know if you all saw the headlines here as of late, but in June, the Treasury had a surplus. They collected more revenue than they spent. And so that's a great thing, obviously, because of the massive debt problems that we're having. And so it seems to me like this is being used for negotiation. We'll get into this a little bit, but you can see here that a lot of the data, these were two different data sources, that it seems like this 15% is essentially be the average rate that we see, and that's through some countries getting preferred tariff rates, but then also looking at some, we're going to get some of these reciprocal tariffs that are pretty high because of just maybe some of the anti-competitive, effects on the U.S. economy, and that might cause some of these tariff rates to be higher. But it looks like we're going to settle into this 10 to 15. 15 is what we're projecting right now, but that might change. This is just kind of the tariff policy. I think this has made everyone's head spin this past, let's say, 4 months, where, early April we were at 23%, and then we had semiconductors, and you can see all the headlines here, 28%. Then there was like a tariff reduction that, U.S. and China had a 90-day deal, and then the UK had a deal. So there's all of this noise happening. And again, this uncertainty might lead to a slowdown in the economy. So far, it hasn't. That is obviously our concern, is that if we don't have a set strategy, it will have the outcome of business owners delaying decisions, which then is not great for the economy long term. But in the near term, it has not really been an issue. So let's kind of go through some of these numbers. And so these numbers are changing. You can even see here, I guess the last data we pulled, not off those charts, was that the tariff rate's in the 17% range. A lot of these increases are targeted at China, on the EV side, semiconductors, solar panels. in the steel industry for sure, trying to protect our U.S. steel industry. Some of the policy intents. Again, I want to stay away from the political side of things, but at the end of the day, I highlighted this on here, is just this idea of reshoring. I think going through COVID, many of us realize that we're so dependent on manufacturing outside the U.S., specifically in China, where most of our pharmaceuticals are made, most of our chips are either being made, where our iPhones are being produced. And so the whole idea is, how do we reshore more of this? And so that if we have any global conflict, or any future issues, that we have more of this manufacturing done here in the U.S. And so there's definitely policy intent around there. And I think if we could summarize it pretty simply, it's in this idea of reshoring. And there's going to be some supply chain risks that are not going to go away. I don't think this noise is going away. I think this is going to be with us probably all of Trump's term, but for sure the remainder of this year as they get through the deals and the negotiations. A headline, I'd even prepare for this, but it looks like there's negotiation with the European Union as of just a few days ago, which is obviously a positive. Anytime we can get through the negotiation and get to a deal is good, because then we can move forward. Because once we have rules to play by, it makes the economy function much better. Some of the areas that potentially could manifest themselves short term, import prices may rise, which could cause some inflationary pressures. The data that I've seen on corporate margins, this could infect profits, and I think that's the concern for the stock market, right? Is that if there are additional costs that companies have to pay, what's that going to do to their earnings? The data that I've seen is that on the whole economy, it's fairly insignificant. It's a pretty small percentage, and so that each company might have an impact. When we look at the broad markets, that the corporate margins being compressed and hurting earnings is not going to be, is fairly insignificant, but certainly we're seeing a lot of headline risks in the short term. You can see some of the sectors that are more vulnerable to this: retail, auto, electronics, and then obviously there's some beneficiaries, right? We're seeing industrials do better, domestic manufacturing, things of that nature. And then, the interesting dynamic is, I think that there was a lot of chatter early on is, this might just be a temporary threat. This might just be noise out there right now. But it seems to me that this is going to be a permanent policy, at least for the Trump administration, around generating revenue for the Treasury. So this looks like this is going to be something that will be with us. And we'll see the longer term impacts of modest levels of these tariffs. If you're new to Vance Wealth and you're just uncertain about what's happening with your tax strategy, your investment approach, or you just want a second opinion, we'll do a complimentary consultation. So please just reach out so that we can, we'll want to gather some documents, ask you some questions, and then we'll be able to give you a report that does a deep dive on your investments and your plan and give you some guidance, and maybe would be a good fit to help you on a go-forward basis. You can reach us, you can schedule an appointment, just go to vancewealth.com and you can schedule an appointment there, or you can call the office at 661-775-0950. Thank you very much. I hope you found our 2025 mid-year economic and market update valuable. Again, please like and subscribe on the YouTube channel, and we're looking forward to reconnecting in the future on our next video. Thanks.